Friday, mid-morning to you guys. Welcome to Financial Futures for Kids. We're here again this week with Jennifer Schmidt from Three Rivers Federal Credit Union, and she has a video for us today, and we'll do some talking about credit. So go ahead and take it away, Jen.
All right, so today's topic is about credit scores, and this is one of the things that the earlier you understand how it works, the better off you will be, because there are many things in life that we get based on credit score. So cell phones, rent, a home, a car, all of those things usually pull your credit to see how well of a borrower or how likely are you going to pay someone back. So at Three Rivers, we have a video that breaks down credit scores and how they work. And so I want to share that with you today so that you can learn about credit score basics.
What purpose does a credit score have? How does it impact you? How does it impact you financially? First, a credit score is built up of several different attributes.
Yep, there we go.
We're going to take a look at is payment history. Making on-time payments will build your credit score quickly. Even one 30-day late payment on a loan could cost you even 60 points off your credit score overnight. Next thing we're going to take a look at is capacity. Capacity weighs in at 30% of your credit score. This is going to take a look at how much you owe in the debts that you currently carry. So one of the major impacts of capacity here is your revolving lines of credit. Like your credit cards, the more you owe on your revolving lines of credit, the bigger impact it could have on your overall credit score. One of the things to remember is that some experts estimate that for every percentage point you use on your revolving lines of credit, you lose 1 point off of your credit score. So here's an example of capacity. Let's say that we have a credit card with a $10,000 limit, and we have a $4,000 balance. Our balance to limit ratio is 40%. Now, a good strong target to maintain on revolving lines of credit is 25 to 30% balance to limit ratio. Of course, the best ratio that you can hold is 0%, and that's by paying off your credit cards every month. Okay, the next thing we're going to take a look at is length of credit. This is 15% of your credit score. Length of credit is determined by the oldest trade line on your credit report. This might be why you've heard, don't close the first credit card you ever open. The next thing to remember about length of credit is not to open several new trade lines in a short period of time. Let's take a look at a scenario that will help explain this a little bit more. Okay, so let's say that you have a Three Rivers credit card and you've had that card open for 10 years. This is the oldest trade line on your credit report. This is going to help establish your length of credit. You also have another credit card that you've had for 2 years. To find the average age, we're simply going to total up the number of years that those lines have been open and divide it by the number of cards you have. In this case, we do 12 divided by 2 gives us an average age of 6 years of credit. Now, let's say hypothetically you go out and you open up 4 more new lines of credit. Well, now we still have 12 years total, but we're dividing by 6 cards now. That gives us an average age of only 2 years. Your credit score just dropped. The next thing we're going to take a look at is accumulation of debt. This is 10% of your credit score. Accumulation of debt is important because it introduces something called inquiries. Inquiries are indicators of people who have pulled your credit to determine your credit worthiness. Just a note, each inquiry is estimated to cost just under 5 points off your credit score. Why is this important? You want to be selective in how many times you ask people to pull your credit and how often you're applying for credit. So we're going to take a look at some of the different types of inquiries. Voluntary inquiries are when you apply for credit and ask someone to pull your credit report as a condition to get the loan. These will show up on your credit report for the last 24 months. However, it only impacts your scoring for the last 12 months. Involuntary inquiries do not impact your credit score. These could be for account reviews, promotional offers, employee inquiries, or insurance inquiries. The last one is your mix of credit. This is 10% of your credit score. This is going to take a look at how much of what type of debt you have out there. Revolving, installment, and mortgages are the 3 basic types of credit. Revolving is kind of like bad cholesterol. It's okay to have in moderation, but you don't want to build an entire diet around it. Installment is like good cholesterol. It provides great benefits in credit building process. And finally, mortgages, your most watched trade line on your credit report. This is your largest investment, and it's a good indicator of how you handle all other debt payments. A credit score goes a long way in many different areas. It helps to support budgets that you may have in place. Overall, it'll save you a lot of money if we're able to maintain a good, strong credit score. The better your credit score, the lower interest rates you pay on loans that you take out.
Okay. There you go.
So hopefully you've learned a little bit about the importance of credit score and being responsible with that and being selective who pulls it, how many times you pull it, and making good financial decisions to keep your credit score above 700. So please comment below if you have any questions so that Nikki or I could follow up with you about credit scores.
Thank you guys for joining us. We hope you have a fantastic Friday. It's gorgeous outside. Join us again next week when Jennifer presents again. Have a great weekend, guys.
Bye-bye.